Hello and welcome to Portfolio Matters. And it is total chaos in the markets, and we are here to provide some sort of a guide. So before we get into it, Richard will read a disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Got a few things to talk about this week, Keith.
We certainly have, Richard. So this week we are going to concentrate on the tariffs announced by Donald Trump and the implications thereof. We will go through all the economic data, but warning, we're going to go through it at speed because I think that what matters is the future as opposed to what's happening in the economy now. The if tariffs stay in effect, then that changes the world economy and it changes the outlook for all the economic data. Okay, before we get going, let's quickly talk about the economic effects of tariffs. And so this is from a paper by Paul Krugman, and it shows how the imposition of tariffs affects the market for domestic TVs. So this is a standard supply demand chart, and before you allow imports of TVs, equilibrium is at E1. When you allow imports, then the price falls from PA to PW, and domestic supply, which had been this cube here, this rectangle here, declines just to this area Y. Imports increased from QT to CT. Your domestic production reduces from QA to QT. Now, so what happens is there's a big increase in the total size of the market, and you have a big increase in imports at the expense of domestic producers. Now, when you impose tariffs, you claw some of that back for domestic producers. Look at the size of the imports, though. They collapse. Prior to tariffs, you have imports Q1 to C1. After tariffs, they collapse to Q2 to C2. You only get a small increase in domestic production, and you get a big deadweight loss. That is the loss of consumption in TVs, and that's borne by the consumer. Reminder, tariffs are domestic tax. So it increases domestic tax revenue at the cost of external exporters and consumers. Now, bearing that in mind, going into Liberation Day, so the US announced huge reciprocal tariffs on all its trading partners, including, the UK and, frankly, its traditional allies. And the EU has promised to retaliate. China has retaliated over the weekend, imposing 34% tariffs. We'll take you through all that data. Mexico and Canada do seem to have secured concessions and will now only pay 12% tariffs on non-USMCA compliant goods. That's the Mexico-Canada American trade agreement. It's imposed 25% on all car imports, and these tariffs on top of other tariffs. So car imports from the EU will therefore see a rate of 45%, 20% plus 25%. Now, you've seen over the weekend, Jaguar Land Rover, the UK car exporter, suspended all its car exports to the US, awaiting further development. Canada has retaliated with 25% tariffs on US vehicles. Now, there are exemptions for pharmaceuticals, semiconductors, and lumber and other certain minerals. So the exact the exact tariff rate a country will face depends on its mix of exports. Countries such as Ireland, which mainly export pharmaceuticals, face lower tariff rates. So the 10% tariffs have gone into effect. They went into effect on the 5th of April. The reciprocal tariffs are due to come in on the 9th. So this chart shows the tariffs that various countries are going to face. Notice that Vietnam faces tariffs of 46%, Cambodia 49%, China 34%, and those are in addition to previously announced tariffs. The FT estimates that tariffs on Chinese goods will hit 65%. Now, how did they calculate these reciprocal tariffs? Well, they did a very simple calculation. They took the US's goods trade deficit with any particular country and divided it by the total amount of goods imported from that country and then cut it in half. So the US imported 8.4 billion of goods from Bangladesh in 2024, and the US had a 6.2 billion trade deficit with Bangladesh. So 6.2 divided by 8.4 is 74%. They halved it, and that gave them a tariff rate with Bangladesh of 37%. And you can see that calculation perfectly fits the tariffs rates the US has imposed. The only exception is for the EU, where it imposed a blanket 20% tariff, and obviously the countries of the EU have different export regimes, balances with the US. So that meant that Ireland, Slovakia, and Slovenia did better than France and Spain, according to this formula. Now, the Trump administration claims to have used a much more complicated formula at the top here with some added Greek letters, but the epsilon and the other one cancel each other out. So you get back to that simple formula that we've just shown you. And what's very odd about this whole thing is that it fetishizes goods trade. So, yes, the US is a huge importer of goods from the EU, but actually its trade overall with the EU is balanced because it's a huge services exporter, and it has not taken that into account when considering its overall trading relationships with any country. So, you'd now expect US service exporters to suffer in a trade war. So what are the implications of all this? Well, first of all, global GDP growth, but particularly US GDP growth, is going to be lower because tariffs are a huge domestic tax. BCA Research estimates that tariffs will reduce US growth by 0.5 to 1%, and that's before secondary effects on sentiment, investment, etc. You have seen that in recent days, the S&P 500 has dived and equity markets are down best part of 20% from recent peaks. Now that will reduce consumer wealth, and that means the wealth effect will also be negative, reducing people's propensity to save. Inflation will be higher in the short term in the US because price of imported goods will go up. However, the oil prices have also dived, and there's likely to be diversion of traded goods from China to Europe and the UK. So it's possible that UK inflation could actually be lower. Will the EU and Europe attempt to reduce the flood of goods from China by imposing tariffs of their own? If all the proposed tariffs go into effect, then US PCE inflation in 2025 could be around 1.5 to 2% higher than pre-tariffs. Finally, US interest rates. Well, Jay Powell gave a speech last week in which he said the Fed was well positioned. The trouble is that tariffs will raise inflation in the US in the short term while also reducing growth. So the Fed's dual mandates are in conflict. Now, the trouble for the Fed is it wants to stop higher initial inflation turning into longer term inflation and prevent workers from attempting to compensate themselves for higher inflation by demanding higher wages. It's therefore likely to keep interest rates higher for longer, all of which would be bad for growth. And Jay Powell has not indicated that he's going to cut rates despite demands from Donald Trump. So, what are the investment implications for that? Well, stocks bearish. Lower growth means lower profits. Trade war, bad for profits. Higher input prices on imported goods and components, bad for profits. All of that very bad for equities. And you've seen equity markets come off in the recent days. Bonds bullish. Growth expectations down, safe haven buying, medium term inflation's likely to come down. You've seen because poor economic growth is bad for employment, and that brings down wages, and that should bring down inflation. We've seen safe haven buying of bonds in the last few days. Inflation-linked bonds the same. Gold bullish. Safe haven buying amidst the chaos. Now, gold has come off in the last couple of days because when there is general liquidation in financial markets, people sell what they have to, not what they'd like to. And they've been selling gold because they're getting margin calls. But as soon as that ends, gold is likely to resume its bull run. Richard, your thoughts?
The markets were expecting something to be happening, but the response that we've seen in the markets suggests that generally speaking, people had no idea the size and sort of vigor of the tariffs that Trump is applying, and that they probably didn't really believe that he'd go through with it, and he has gone through with it. And as you say, it's creating complete chaos, and trying to predict where the pieces will land ultimately is very, very difficult, if not impossible. Yeah. And I think, I mean, we've got this situation, haven't we, where we know the US stock market is overvalued, has been overvalued, and we've commented on it for a long time. And a lot of that overvaluation is being knocked off right now as we speak. We've got a lot of shares held on margin, and that is, I'm sure a lot of people are exiting those positions as quickly as they can. So many uncertainties with all this. I think your summary was very good, Keith. There's so many uncertainties with it all that you just have to try and keep yourself in the safest places you can. And I suspect this is not an issue that's going to go away quickly. I think that it's going to take a long time to resolve itself.
I completely agree with that final point of yours, Richard. I mean, historically, I have always been far too early in anticipating the end of a bout of volatility. And the reality is it can last a long time. And what Donald Trump's done, even if he reverses the tariffs tomorrow, he has really upset global certainties, added huge amounts of policy and economic uncertainty into the global markets, and upset all his trading relationships. It is very doubtful we'll go back to where we were, even if tariffs were not imposed. Anyway, to carry on, Fitch estimates that the new tariffs will raise average US tariffs to 22% from 2.5% previously, and to levels last seen pre-World War I. And the reality is that when you look at the overall trade balance, the US has imposed tariffs on countries where it has a net positive overall trade balance. It really suggests that that Donald Trump's given reasons for imposing these tariffs are not the real ones. He wants to reduce the US's trading relationship with the rest of the world. And these are the Heard and McDonald Islands in the Antarctic. In population zero, Donald Trump has singled them out for 10% tariffs. And obviously, markets reacted incredibly badly. This was on Thursday, the morning after Liberation Day, and that was a historic day. You can see markets fell almost 5%. They fell 5% on Friday. They're likely to be down again today. These are some of the largest declines in stock market history, and it's very rare to get those declines day after day. So this is the S&P 500, fallen like a stone and likely to fall further today. Markets overnight, we'll take you through the data. Asian markets have reacted very badly. So what's happened this weekend is last week, going into close Friday, people were unsure of whether the tariffs would remain in place. But there was liquidation. Over the weekend, China has retaliated. Donald Trump has doubled down, so he's basically said that there's going to be no reliefs, that he is going to stay the course on tariffs. And he has offered no relief to traditional big trading partners and allies, such as Japan. All of that has made markets in Asia think that tariffs actually, he's serious, they're likely to stay, and hence the big falls in Asian markets today. The dollar has taken a dive, and even before Liberation Day last Wednesday, the chaotic start of the Trump presidency had undermined US consumer confidence. So this is the percentage of US consumers who think their financial situation is going to improve over the next year, and is collapsed to, frankly, an all-time low since the start of the survey. And that means that consumers are likely to start pulling in their horns and reducing spending. GDP forecasts, and these are before Liberation Day, starting to come down sharply. Credit spreads rising as markets start to price in the probability of a recession. Inflation, 1-year inflation rates, this is in the US, have shot through the roof, but 2-year and 3-year coming down as the market expects an economic slowdown to bring inflation under control. And on the point about 1-year inflation expectations rising, this is a survey from the Richmond Fed of US businesses asking them what they intend to do with the price rises caused by tariffs, and most of them are going to attempt to pass on the full price increase and input prices caused by the tariffs to in final prices. So that's inflationary. So this chart shows what's happened so far in Donald Trump's second term, announced tariffs, and whether he's actually implemented them or not. And you'll see most of them have either been punted, i.e., like pushed further down the road, or dropped, but many of them have been acted on. So it's likely that tariffs will not be as bad as currently announced, but there still will be tariffs. The overall tariff rate will undoubtedly be higher than previously. And all of that will be bad for the world economy. And above all, confidence has been shaken. So this is the policy uncertainty index going through the roof, likely to be going even higher. Tariffs on Chinese goods, we've said, are now 60%. And this is a very good quote. Thank you for TK51 to sending me this. This is from David Kelly of JP Morgan. The trouble with tariffs, to be succinct, is that they raise prices, slow economic growth, cut profits, increase unemployment, worsen inequality, diminish productivity, and increase global tensions. Other than that, they're just fine. So, our thoughts. This is a quote from David Ben-Gurion, first Prime Minister of Israel. You are only a global superpower so long as you don't attempt to use it. Now, my thought is that the Trump administration is attempting to use America's economic power to change its relationship with the world. And I think it's overplayed its hand and it's about to discover the limitations of its economic power. So, what Trump has done is he's imposed these enormous tariffs in the expectation that everyone will come begging to him and then he'll be able to back down and reduce those tariffs, saying he's done a deal. But I think he's overplayed his hand and he now needs his trading partners to come begging so that he can back down. But I don't think they're going to. I think in China and the EU are showing no signs of that. They know that if markets react badly enough, Trump will have to back down. And therefore, any concessions to Trump actually are counterproductive. And so what we've seen over the weekend is China retaliating. I expect the markets to force Trump to back down, not his trading partners. And the US is a big services export. This is really going to affect US corporates. And finally, the difference between democracy and dictatorship is not necessarily the quality of the decision making. Both can make big mistakes. The advantage in democracy is that voters force a change of government and force a change in bad policy. Now, what Donald Trump's done since the start of his term is to attempt to limit some of the counterbalances in US democracy. Will the polity in the US force Donald Trump to change his mind? Richard, your thoughts?
Yeah, I want to ask you a question, Keith, actually. So I think the reason Trump has done all of this, if you take a step back, and I stand to be corrected, but I'm going to take another step back. Yesterday, there was an article in the Sunday Times about Starmer saying globalization has failed, and he's going to give us a talk on that. Manufacturing in the US has been eviscerated by globalization. I think we can say that.
Sorry, Richard, can I just come in here? It hasn't.
No. Well, can I sort of let me. So yeah. The view is that manufacturing in the US has been eviscerated, and that the people who have been damaged by this are basically blue collar workers.
Yeah.
And the problem, I think, is that you cannot take a blue collar worker and move them into a service industry easily, if at all, because of the education level required to function effectively in a service industry is much greater than in manufacturing. So the purposes of Trump's tariffs are to bring manufacturing back into the US. And so the damage clearly is going to be substantial. There's also going to be damage to the service sector. But he was voted in, I think, basically because there are an awful lot of people who feel that US manufacturing has been eviscerated. Mm. So his efforts, the logic of his effort is that the problems that it throws up are enormous. But it is true to say, I believe, that globalization has failed and is failing a very large section of the working population of the Western democracies. And the problem then is, well, how do you change that? So I'm not saying that tariffs are the way to change it, but I do believe that it needs to be changed.
So I'm going to push back on that, Richard. I don't think that globalization has been a failure at all. And I don't think this is the end of globalization. So when you look at unemployment rates in the US and the UK, they're very low. So,
but of course, if you look at labour force participation rates, they're all falling.
No, that's true. But we've got an aging population, frankly. And if you, various friends of mine who are now losing their jobs in their mid to late 50s, very difficult to find a job in your mid to late 50s. So the fall in participation rate is not necessarily due to a lack of demand for jobs. It could be due to a lack of supply for jobs for people who are, middle-aged and quite expensive,
Mm.
frankly. Um, and also, we've seen a big rise in the sickness rate post-COVID in particular. And that, frankly, our definition of sickness and Chinese definition of sickness, I think, is quite different.
Mm.
But also on globalization, what globalization have done is it's been a huge boon for consumers. They have had much cheaper consumer goods. And when you look at the share of manufacturing in the US economy, it has been on a huge downwards decline since the 1970s. And when you look at when China joined the WTO, then the trend has just continued. I mean, I just don't think that imposing tariffs is going to be hugely negative for consumers. And when Trump wants to get the manufacturing back, that takes a lot of investment, a lot of time, and a lot of policy certainty.
So my question then is, I don't dispute what you said, Keith. My question then is that the electorate did vote for Trump, albeit fairly marginally, but they did. And they expected him to do something fairly significantly different to
Yeah.
what the Democrats have done. So what was the electorate expecting to change?
Well, I think they're expecting change, and he's certainly delivered that. But change involves a hell of a lot of disruption. And in this case, where everyone's got used to cheap consumer goods, and are they willing to sacrifice those cheap consumer goods for more manufacturing jobs in the US? Now, I don't think they are because previously, for the last 20 years, policy has been entirely the other direction.
Yeah. I mean, we shall see, won't we? Whether the population becomes increasingly unhappy with the situation in the US in terms of whether they have an understanding of what's going on and they think it's the right thing, whether or not we think it's the right thing, whether they do, we shall see.
Yeah, absolutely. So, well, thank you to Market Timer for sending this. This is what's happened over the weekend. Um, China has imposed a 34% tariff on all imports from the US starting April the 10th, but also it's restricted exports of rare earths and have a read. Trading relationships are unraveling and supply chains will be disrupted. All of this is very bad for the world economy. This is very bad for inequality because the poor mainly consume goods, the rich mainly consume services. Prices in Walmart, which are almost entirely made in China, Vietnam, or Cambodia, they're going to rise sharply. And how is this going to affect the US economy? Well, if we turn to the GDP formula, GDP is consumption plus investment plus government spending plus exports minus imports. Well, consumption, that's going to be down. Higher prices mean lower consumer confidence, lower consumption. Investment, down. It was already falling. We'll show you some charts later. Investment was already falling, corporate investment, prior to Liberation Day. Uncertainty is likely to keep it falling. And frankly, falling corporate profits are not going to help. Government spending, well, that's coming down. That's an explicit Trump policy. Also, you've raised taxes via tariffs, and Doge is cutting government jobs. Exports, they're going to be down, tariff retaliation. Imports, though, are also going to be down, and that's good for GDP. So the question is, does the reductions in consumption, investment, and government spending and exports, are they offset by the fall in imports? I suspect the net balance of this is going to be negative.
Point, Keith. What Trump is saying he wants to do is take the revenue raised by tariffs and use it to reduce taxation.
Yes.
So that, in all other things being equal, that should reduce the reduction of consumption, if you see what I mean.
Well, actually, Richard, what he's planning to do is not cut tax further, is to roll over the
The existing.
current tax cuts. So essentially, that allowed them to keep spending, but the impulse will be negative because he's not cutting taxes further. Now, on Richard's point, the narrative that I've heard in the last couple of days is that tariffs are not just about trade, they're about changing the US's financial and trade dependence on the rest of the world. And so the US debt was on an unsustainable path. Tariffs will help fix that. I would push back on that entire narrative as essentially Donald Trump is largely responsible for the poor fiscal state of the US following his 2016 tax cuts and imposing tariffs in order to try and raise revenue so he can roll them over is unnecessary. All he has to do is simply raise taxes, and the US has huge fiscal space if it wanted to raise taxes and just take us back to where the tax rates prior to where they were prior to 2016. Now, all this is good for billionaires who face lower taxes, and they're bad for poor US consumers who face higher prices. So reducing bond yields, and bond yields are coming down, does help in fiscal sustainability. And the US has an awful lot of debt to refinance. It's got 9.2 trillion to refinance in 2025 alone. Absolutely shockingly enormous numbers. And the debt trajectory, this is prior to tariffs, is totally unsustainable, as we've talked many times. But I think tariffs are here to stay for reasons that we've said. That I think he's overplayed his hand, and he wanted his trading partners to come begging so he could reduce tariffs in a face-saving manner, and they're not, and therefore he's likely to keep them higher. He never apologizes, never admits he's wrong. He'll have to get a lot worse before he's forced to change course. Richard, any more thoughts before we move on to other news?
No, I think you've done a very good job of synthesizing what's going on, Keith. Well done.
Thank you. So on to other news. Okay, so the Fed met and it held rates as expected. It raised its inflation forecast for 2025 and lowered its growth forecast. That was before Liberation Day. Jerome Powell has stated that monetary policy is in a good place. Donald Trump has criticized him for not cutting rates, but he has made no indication that he's planning to cut rates to bail Trump out. The Fed did, though, reduce QT from 25 billion a month to 5 billion a month. UK inflation in February came in soft, but the OBR has raised its forecast for UK inflation, and it's expecting inflation to peak at 3.8% in July. Now, a lot of that is already baked in because we've had rises in energy prices, etc. However, the events of the last few days could completely upend that. Oil prices have collapsed. Commodity prices have collapsed. I'll take you through all that data in due course. Commodity, copper, etc., all have had a very bad week. UK gas prices, European gas prices have also collapsed. So UK inflation could be coming down. Inflation everywhere could be surprising to the downside in the coming months. We'll also take you through the UK spring statement. Rachel Reeves cut welfare benefits and departmental spending to restore fiscal headroom. The gilts market reacted calmly. Now, on Friday, Jerome Powell stated that the impact of tariffs is likely to be more inflationary than previously expected in the coming quarters, but the Fed was well positioned to consider adjustments. It must ensure that price hikes don't lead to persistent inflation. So, frankly, I expect the Fed to keep rates higher for longer unless the US economy really tanks. Elsewhere, OPEC Plus announced that starting in May, it would boost production by 411,000 barrels a day rather than originally announced 135,000. Oil prices have taken a dive because there's more supply and the market is worried about global demand. Some charts relating to the news. So this is from the FOMC meeting. So even before Liberation Day, the Fed was raising its inflation forecasts and reducing its growth forecasts. And obviously is worried about uncertainty. Well, that uncertainty has very much come to pass. Gold's come off in the last few days, but it's had an absolutely amazing run. Markets now expecting, and I was really surprised by this, the Fed to cut 4 times by the end of the year. I think things will have to get a lot worse for that to come to pass. The Fed needs to keep rates high to stop this near-term inflationary impulse becoming more permanent. So although the US does have a trade deficit with China, it does have a lot of exports, and those are going to be hit. So US corporates everywhere are going to suffer from reduced exports and lower profits. And now after all that, onto this week's economic data. Now, we are going to really push through this fast because this is all obviously historic economic data and the world has changed. So expect a lot of new and probably lower economic data in the coming weeks. On to the UK, Richard.
Thank you, Keith. So UK earnings growth 3 months year on year, better than expected at 5.8%.
Yeah, still way too high.
Yeah. UK earnings growth, excluding bonuses, 5.9%, which met expectations, but as Keith says, still way too high. And between November 2024, January 2025, UK private sector pay growth averaged 6.1% versus the public sector of 5.3%. Again, too high for a low inflation economy.
Yeah. Now, later on, we're going to be showing you the Indeed numbers. And what's been really puzzling is that alone amongst all the developed economies, job openings in the UK are substantially below pre-pandemic levels, but our earnings growth is much higher than everywhere else. And that can only be because of government policy. So raising the minimum wage by was it 12% last year and 7% this year?
Yeah. Here we have a chart showing that pay growth has remained strong throughout all the sectors, between over 5% in all sectors.
Yeah. If the government stops interfering in the labour market, mandating higher prices, then wages will come down towards target.
So the UK employment rate 3 months change was up 144,000, which is better than expected.
Yeah. We have reason to doubt that.
Permanent placements and temporary billings indices are still negative.
Yeah. You see, all the other data we're getting, so this is like KPMG, their REC report. So they're saying that actually the number of placements into companies has been falling for, a couple of years now.
Yeah. So the UK unemployment rate 4.4% and flat over the last month, and UK claimant count was up 44,000, which is a lot worse than expected. The HMRC payrolls data was up 21,000 versus 95,000 expected. A really big miss there.
Yeah. But last 3 months, so, previously reported the employment change in the 3 months to the end of January. When you add up HMRC payrolls over that time, it sums to minus 26.3, not plus 155. UK statistics are absolutely awful at the moment. It's very difficult to know what the truth is.
So UK CPI month on month 0.4%, which is better than expectations, but too high.
Yeah.
Year on year, it's 2.8%, which is better than expected.
Yeah, but we know it's going to shoot right up in April because, the primarily because of energy prices, but everything resets in April.
Yeah. And core CPI month on month, 0.4% in February, a bit better than expected. Core CPI year on year, 3.5%, better than expected. UK RPI month on month, 0.6% year on year, 3.4%, both better than expected.
Yeah.
And clothing and footwear inflation negative in February, 12 months to February.
Yeah, so basically the miss was all due to clothing and footwear. And, when we talk about what's going to happen in tariffs, frankly, China's got loads of exports that it's going to divert to countries where there are lower tariffs. So you could well see goods deflation in the coming months.
Mm. So services inflation was unchanged at 5%, and that is not showing signs of falling significantly below that level.
Yeah. Yeah, not great.
No, and UK in February was only very slightly ahead of the EU's, which is good because we've been leading the EU in inflation for too long. So we've got a lot of expensive things happening in April. Water bills going up significantly. Southern Water up 47%. Goodness me.
Yeah.
Energy bills up 6.4%. English local authorities will probably virtually all of them be raising by the maximum permissible amount, 4.9%. Car tax rises. EVs no longer exempt from car tax, which I have to think is a good thing. But after all, they use the roads, don't they? Broadband, telephone, TV licenses all going up, and stamp duty on housing transactions going up significantly in terms of the lower limit being reduced. So, and we have fiscal drag, i.e., tax bands not being changed, but people's salary pay going up. Introduced by Gordon Brown, I believe.
Yeah, it's a good stealth tax.
So you have UK manufacturing PMIs, 44.9 March, worse than expected. Not a very happy looking chart. UK services PMI looks more healthy and ahead of expectations in March.
Yeah, I was very surprised by this. The UK economy prior to Liberation Day seemed actually to be remarkably resilient.
And as composite PMI, slightly better than expected for March. UK car production. This is also going to be damaged by the tariff situation, but anyway, it was down 11.6%, which is actually better than expected.
Yeah, I mean the thing is, what we export is very expensive cars. We export Aston Martins, Bentleys, Rolls Royces. They're all going to have 25% tariffs put on them. Yeah. We need to develop other markets.
UK retail sales month on month up 1.1% in February, which is significantly better than expected. Year on year up 2.2%, again significantly better than expected.
We know that actually that UK consumers have saved quite a lot of money. They've got resources. They're just not feeling very confident.
Yeah. So the CBI distributed trades was down 41% in March, which was a lot worse than expected. Down, 41 points in March.
Yeah.
The UK consumer confidence in March was minus 19, which was better than expected.
Yeah, I suspect that's going to take a big hit in April.
Yeah, and the CBI industrial trends, new orders was at minus 29. Again, slightly better than expected, but a pretty unhealthy looking chart.
Yeah, you'd say the downwards trend has not been broken.
No. Halifax house price index month on month in February was 0, and year on year was 3.9%. M4 money supply was up 0.2% in February, which was below expectations of 1.1%. UK money supply fairly flat at the moment. M4 public sector borrowing requirement was 10.7 billion in February, which was significantly worse than expected.
Yeah, they also revised down
January.
That's for January.
Yeah.
So UK public finance is not in control.
The economic surprise index, I think that's going to have a spike in it, isn't it, Keith? Next time they measure it.
Yeah, we're going to do another episode next week, by the way, and then return to the bi-weekly schedule.
The Indeed jobs posting index, although flat against the earlier readings, recent earlier readings, it's still in that downward trend, 82.7.
Yeah.
UK wage growth, 5.7 in February, as we've discussed, too high.
Yeah, but actually starting to come down.
Yes. And gosh, the UK is the only country covered by Indeed that has fewer job openings than pre-pandemic.
Yep.
And despite that, wage growth has been much stronger than the EU or US, as Keith says, almost certainly a result of government policy. UK redundancy notifications are remaining low. This is over the past 2 years, UK spent 4.6 billion on military assistance to Ukraine.
Yeah. It's interesting.
Yeah. And we have the rise in the minimum wage for national insurance announced in the autumn budget take effect. And these are going to raise wages for those workers by nearly 8%.
Yeah. Yeah, so this shows the effect on the the wage distribution of the rise in NI is going to make hiring low-paid workers much more expensive.
Yeah. So the hospitality sector, which uses a lot of low-paid workers, is going to be particularly badly affected. And national insurance contributions badly affecting pretty much every sector.
Yeah.
And there are ways in which UK firms are attempting to cope with the minimum wage and NI increases. We cut wages, cut hours, or move employees to self-employment, which is quite a tricky. The last thing is quite difficult to do.
Well, actually, there's a company that employs drivers who work for the pizza companies, etc. Delivery.
Yeah.
What they've done is they sent all their workers a notice saying either agree to lower wages or move to be self-employed contractor.
Mm. Yeah, I think HMRC might challenge that though. That's the problem with moving people onto self-employed contractors. HMRC doesn't like it.
Basically, the Resolution Foundation expects a 0.7 drop in employment for the lowest bottom decile.
Yeah. UK income growth has stalled to real household disposable income per person by decade.
I thought this was really interesting, actually, because we all think of the 70s as a total disaster. I mean, politically it was, but actually, UK consumers did really well in the 70s.
Millionaires fleeing Britain. I mean, this is just bad news for the country.
Yeah. Although, so I went running yesterday with one of these billionaires who has fled the country, and actually he's allowed 120 days here. So he's kept his house. He's just moved to, Switzerland, and actually is here for, 118 days of the year. So I think this might exaggerate the level of migration.
Yeah, possibly so. And this is UK trueflation, 2.3%.
Yeah, and actually, I was really reassured by this. I was expecting a huge spike in April, but actually it's showing the prices are coming down.
Yeah, well, we'll see. So summary, earnings growth is just beginning to slow very slightly, but it's too high. Employment numbers, we have contradictory stats, and we know that UK stats are a mess. Inflation, it's soft at 2.8%. We don't really know what the effect of tariffs is going to be on inflation. We've got oil prices plummeting. March PMIs were good, but obviously we've got a lot of turmoil, and so UK economy is sort of bumbling along at around a tiny bit of growth, but there's a lot of things going on that could push it off, of course. And of course, we need a great deal more growth because we are
Yes.
spending too much money
Yeah.
in the public sector.
Well, the trouble is that the Tories, frankly, have totally messed it up. So when you look at the trajectory of UK debt, it wasn't so long ago, it was only 40%. And under Gordon Brown, it's like 40%. It's now at the best part of 100%. And most of that was spent by the Tories. And now, as you keep on saying, Richard, essentially what we've done is we've had this huge boost to growth over the last, 2 decades under the Tories. But now we've run out of fiscal space or like ability to
Yeah,
borrow anymore. And so
indeed.
we now have this pro-cyclical fiscal policy where if growth is bad and revenues come in low, then we have to start raising taxes to stop the PSBR from going out of control.
And if we wish to reduce the overall level of debt in the economy, we have to go into recession to do it.
Yeah.
Or at least we have to reduce the contribution of debt by the amount that we're repaying from GDP. So if you reduce debt by 2% per year, you're taking 2%, very roughly speaking, 2% hit on GDP per year. I mean, we've just got ourselves into a complete mess. And Rishi Sunak,
Yes, I
he
know.
he was like the Christmas fairy.
A lot of this can be traced back to the pandemic when the UK just was handing out money like it was sweeties. And we're now paying the price for that. But, then it was incredibly popular. Yeah. But now we really have to pull in our horns. And so the other point I'd make is that the only way to reduce public sector debt while we're maintaining GDP is for the private sector to re-gear. So you need an increase in private sector investment to offset any public sector deleveraging. And that means you need interest rates much lower.
It also means, Keith, that um, the hands of the bureaucratic hands that are slowly throttling the life out of the UK economy need to be removed. And there has to be a huge rollback of government interference.
Yeah, I completely agree. Which brings us neatly on, Richard, to Quiz of the Week for UK. Okay, so the government has finally given the go-ahead to the Lower Thames crossing, which will cut congestion over the Thames from the M25. How long did the planning process take, and how much did it cost?
Well, I'm going to take a flyer on this, Keith. Knowing I'm going to say 250 years,
Yeah.
and so the cost. I mean, I bet we spent hundreds of millions on it, did we?
Well, so 8 years, and actually the planning cost, we haven't even dug anything yet. Planning cost
1.2
was
billion.
1.2 billion. The planning application, frankly, I've had a look at the planning application. It's
Did you read it
unbelievable.
before you critique it? Did you actually read it, Keith?
I just looked at the number of subsections and appendices. They were unbelievable.
You should get AI to produce a précis on it.
Yeah. So the planning application ran to 359,000 pages. Okay. And it's a tunnel. It's a tunnel. Yeah. But the Thames Crossing Action Group attempted to stop it on the basis of the bats. Now, I just looked at the number of technical appendices. They were incredible. The Paleolithic, Paleolithic sites, affected, etc., etc. And 5 of these appendices were dedicated to bats. It's a tunnel going under the Thames, and 9 of them to newts. So, yes, on your point about trying to get anything done in this country, there you go. Onto the EU. So, CPI came in at 0.6%, in line with expectations, up on February. Again, the EU's like the UK, most of the inflation occurs in the first few months of the year. So CPI year on year came in slightly soft, 2.2%, actually getting close to target in the EU. And core was better than expected, and that is great news, 2.4%. below expectations, down on February. So inflation in the EU is falling even before Liberation Day. The unemployment rate continued to tick down. That was unexpected. And so the EU actually has the best employment it's ever had. Labour cost index was better than expected, 3.7% year on year in Q4. Wage growth, 4.1%. Construction output, better than expected in Q4, but still not great. Falling. Balance of trade, well, in January, it was only plus 1 billion, much worse than expectations. Manufacturing PMI actually had been improving. Now, there's been a huge temporary boost to manufacturers all around the world due to US companies attempting to get ahead of tariffs by building up inventories. We'll show you the data later, but that is temporary. It's likely to fall back now. Services also in line with expectations, but better than February. So again, the EU economy is showing surprising resilience prior to tariff day. Loans to companies growing at 2.2% below expectations, but growing. Loans to households recovering, but still at an anemic 1.5%. M3, 4%, slightly higher than expected. Inflation expectations actually under control, unlike the US, 2.6% below expectations. Expectations had been for it to rise. Economic sentiment, not great, falling. That's not going to improve. Industrial sentiment stuck in negative territory. Services sentiment, this is interesting, fading. Now, that is worse than the S&P Global Services PMI, which showed a slight uptick. Selling price expectations rising again. That is not great, but the actual inflation numbers were good. Economic sentiment actually improving sharply. That was much against expectations, but that will almost certainly change. Citigroup Economic Surprise Index still positive. The job postings, this is prior to Liberation Day, dropping still in Germany. Wage growth in Germany, 2.9%, perfectly compatible with a 2% target. French Indeed job postings actually bounced slightly. Wages, 1.7% year on year, very weak. Now, reminder, Germany is a huge exporter to the US, so very vulnerable to 25% tariffs. The imports as a share of US vehicles are led by Volkswagen. Number 3 is Mercedes. Number 5 is BMW. But when we look at the EU as a whole, the impact of tariffs is going to be very uneven. So Slovenia and Ireland, which mainly export pharmaceuticals, are going to face a tariff rate of less than 4%. Slovakia and Luxembourg, well over 20%. So EU summary, well, inflation seems to be coming under control and employment hit a new low of 6.1%. So it seems the EU economy is stuck in sort of stagnation rather than stagflation. But it is going to be very badly hit by the tariffs if they stay in effect. Let's see what happens. On to the US, Richard.
Thanks, Keith. So US interest rates flat at 4.5%. Non-farm payrolls, 228,000, which is better than expected.
Yeah, actually, non-farm payrolls out on Friday, much better than expected. Market didn't care. Market collapsed because what matters is the future, not the past.
So we saw broad employment growth, particularly actually strong in education and health services, and leisure and hospitality.
But the construction sector continues to add jobs. Reminder, if you're going to see an employment downturn, a recession, what you expect to see is construction being one of the first sectors to turn down, and it hasn't turned down yet.
So Goldman Sachs expecting growth in healthcare, education, government jobs to slow very dramatically this year for reasons of Doge or doggy, however you like to pronounce it.
Yeah, absolutely. So that would mean, when you look at historically what's been a big driver of employment growth in the last couple of years,
Yeah.
has been those sectors.
US average hourly earnings 0.3% month on month, which met expectations, and year on year 3.8%, which is very slightly below expected. And that trend continuing downwards. US unemployment rate 4.2% in March, slightly above the expected 4.1%.
Yeah. And it's been ticking up actually for a couple of years now, but it's still
Yeah,
pretty
very
low.
gently.
Yeah.
The US U6 unemployment rate was 7.9% in March, which was better than expected. And the US participation rate, 62.5% in March. Not really very much change from.
Yeah. Now, I think these two are related. I think what's happening with the U6, so U6 includes discouraged workers. I think what's happening is they're trying to get a job again.
Yeah. US average weekly hours, 34.2, which is flat. JOLTS job openings 7.57 million versus 7.6 expectations. So it's okay.
Yeah, back to the upper end of its pre-pandemic range. So
Yeah.
the jobs market in the US is normalizing very slowly, but it's still, there's still a lot of job openings out there.
It's taking a long time, isn't it?
It is, yeah.
The quits rate, 3.2 million, in line with expectations, and sort of back to pre-pandemic level, roughly.
Yes.
Construction job openings, as Keith said, are still growing.
Amazing.
And the job opening rate has been stable for a number of months, but you'd expect if it falls anymore, you start to see unemployment rising. So far, there haven't been very many federal government layoffs, but one would expect that, all other things being equal, to start to increase with the efforts of Elon Musk.
Yes. Yeah. We know that really starts to kick in this month, April.
Yeah. And the ADP employment change, 155,000 in March, much better than expected, so that's pretty healthy. And challenge of job cuts suddenly spiked up. But is this to do with the government layoffs?
Yes, it is.
Yeah.
And reminder, the Challenger job cuts. So these are announcements. These actual layoffs happen further down in time.
PCE inflation month on month 0.3% and year on year 2.5%. And core PCE inflation month on month 0.4% and 2.8%, very slightly above expected.
Yeah, not great.
US personal income month on month 0.8%, which is better than expected.
Yeah, really high actually.
Yeah.
So dividends have been a big source of personal income.
And personal spending month on month 0.4%, just very slightly below expectation. Retail sales month on month 0.2%, so worse than expected. Retail sales year on year 3.1%, again worse than expected. And US retail sales are down over the last 2 years, very gentle downward slope there, and have now dropped below the long-term trend.
Yeah, so we report nominal,
Yeah,
real, going nowhere at all, and that's the thing. The US low income consumers have had a bad time of it, and the top 20% of the income bracket now account for well over 50% of total retail sales.
US industrial production month on month was better than expected at 0.7%, and year on year it was worse than expected at 1.4%. And strong February industrial production numbers driven by a big 4.9% increase in car production. Is this a tariff effect? Well, I think it remains to be seen.
Well, I also saw that Stellantis put a load of US car manufacturing workers on furlough because they fear the disruptions of their supply chains, etc., from the tariffs.
It's really,
Yeah.
that seems a bit sort of back to front, doesn't it?
Well,
I
yeah.
suppose depends whether, yeah. US durable goods orders month on month, 0.9% up, so it's better than expected. And construction spending month on month, 0.7%, which is also better than expected.
Yeah, amazing. Amazingly resilient.
The annual change in construction spending has been steadily falling, and actually it's as low as it's been, if you ignore the pandemic, since 2015, at least 2015. But jobs have continued to rise.
Yeah, so growth is slowing, but it's still growing.
So the New York Fed Empire State Manufacturing Index minus 20, which is a lot worse than expected. The housing market index at 39, which is lower than expectations. New building permits 1.46 million, which was pretty much in line with expectation. Housing starts 1.5 billion, was better than expected.
Yeah.
Existing home sales 4.26 million, which was better than expected. The Chicago National Activity Index 0.18 in February, much better than expectations. And the manufacturing PMI 49.8, which was below expectations.
Now, it's going to be interesting to see what happens to this. Does the
Yeah.
manufacturing shoot up now?
It should do, shouldn't it? According
Yeah.
to Trumponomics.
Yeah, I suspect it won't. Well, we'll have to wait and see. Watch this space.
So inventories have been built up as manufacturers have front-run tariffs to avoid, obviously, the tariffs on their inventories. So we shall. This is chart of new order versus inventory spread. Where this chart goes now will be interesting.
Yeah, but in the short term, you'd expect manufacturers now to be running down their inventories.
Yeah. The US services PMI was 54.3, which is better than expected.
Yeah, so actually, looks like the US economy is doing just fine.
And the composite 53.5, better than expected. The ISM manufacturing PMI was 49, slightly worse than expected. And the Michigan Consumer Sentiment Index 57, a little bit down on expectations, but actually over the last couple of months, fallen very sharply. Michigan consumer expectations 52.6, worse than expected, and again it's fallen sharply. 1 year inflation expectations 5%, worse than expected, and rising sharply. 5-year inflation expectations 5%.
And this is the problem for the Fed.
Yeah.
Yeah, it can't let expectations get out of control.
Which is why it can't reduce rates quickly.
Yeah.
The US Conference Board consumer confidence 92.9, slightly worse than expected, but on a downtrend since 2021. US goods trade balance minus 148 billion, worse than expected.
Yeah. So front running of the tariffs.
Yeah. Initial jobless claims 220,000, a bit better than expected. Continuing jobless claims 1.87 million, slightly better than expected.
Yeah, not growing, actually.
And the Indeed jobs posting index still declining very gently. The wage growth index 3.1%, unchanged from February.
Yeah, perfectly compatible with the Fed's target.
Yeah. And LinkUp is continuing to report rapidly declining job openings in the US. Or is it reporting rapidly declining business? I never know. Dallas Fed weekly economic GDP 2.3%, down from last week's 2.7%. And Atlanta GDP now minus 0.8%.
Yeah, so you're looking at the dashed line. The solid line includes gold imports.
Right.
Distort the figures, but so the Atlanta Fed one is much more pessimistic than all the others.
Yes. New York Fed GDP now cast 2.6%. and the St. Louis Fed 2%.
So none of them. So the Atlanta Fed is really an outlier. All the others are saying that actually the US economy is doing just fine.
The Economic Surprise Index minus 3.3, better than last week. Trueflation 1.9, sorry, Trueflation 1.68%.
Yeah.
Slightly higher than last week. And consumers are expecting higher US inflation, but so far the bond market hasn't reacted to that. And the median US voter does not care about trade policy and tariffs, but they do care about inflation.
Yeah.
And they also care about the level of the stock market because household equity ownership is at an all-time high. Not anymore, I suspect.
Yeah.
And analysts have started to raise their US inflation forecasts and lower their GDP forecasts.
Yeah.
Which is going to cause the Fed some problem.
Exactly. Exactly. The Fed is in a bind.
Yeah. And this is a tracking of federal expenditures in real time. In comparison with last year, not much change.
No. Now, so I downloaded this data from a website which has daily debt numbers for the US. And I should caveat this by saying that actually it depends on the number of working days in each year, because obviously the wages go out on each working day. And so one working day either side could actually change the relative growth. But of course, the debt has grown by 1.5 trillion over the last year. So, you know, the as interest rates are high, you are always fighting to try and just keep debt under the deficit under control because your interest payments rising every year.
Yeah. And the US fiscal deficit impulse is still positive.
Yeah. Yeah.
So the world economy is benefiting from short-term boosts as US importers have front-run the tariffs. But of course, we're now going to face a period of destocking, and then whatever the pressure is on imports to the US of tariffs.
Yeah.
So, in summary, non-farm payrolls looking good. Earnings growth has slowed to 3.8%, which is compatible with a 2% inflation target. Unemployment is still pretty low at 4.2%. Challenging job cuts relate to Doge, and job openings have resumed their fall. So the US economy is still resilient. However, the stock market has dropped significantly. Is that going to cause consumers to draw in their horns? I suspect so.
Yes. And on to China. So National Bureau of Statistics, manufacturing, non-manufacturing PMI 50.8, better than expected. General at 51.4, better than expected. National Bureau of Statistics saying the economy is doing better. The Caixin private sector PMI also better than expected. Manufacturing services also better than expected. General better than expected. Obviously, this is prior to the tariffs. House prices continuing to fall at a rate of 4.8% year on year. Not good. Industrial production, according to the official figures, growing at 5.9% year on year. Question mark. Retail sales 4% year on year. That looks decent. Investment growing at 4.1%. That's good. Unemployment rate, though, ticking up. If everything's so rosy, how come the unemployment rate is ticking up? Industrial profits, down 0.3% year on year in February. Construction activity is still falling, but sales of property are outstripping new supply, which implies that at some point the market will bottom. We've shown you all that China data seems to suggest that the Chinese economy is doing better, but the China Beige Book, which is a private sector survey of Chinese companies that aims to get around the manipulation of the official statistics, you're looking at the sales revenue across sectors. And so The dark blue is March. Yeah. Everywhere they're reporting actually sales revenue has been falling. So the private survey showing much worse statistics than the official survey. And the backdrop to the Chinese economy is that previously it was getting a lot of jobs because it had cheap workers. Well, over the last decade, that is no longer the case. Chinese workers have become more expensive, and it is losing those low-paid work in the textile industry to Cambodia and Vietnam. Hence, Cambodia and Vietnam's exports to the US have been rising. So Indonesia and Vietnam, as well as Cambodia. And so you've had low-paid manufacturing jobs moving elsewhere in Southeast Asia. And actually, China has been using vast amounts of industrial robots to cut labor costs. So it has installed around half the world's industrial robots. And that's not going to improve. The flow of migrant workers into Chinese factories is slowing. So China is going to have to move up the value chain, and tariffs in the US will not make that easier.
They've also, I was saying, they've also got a lot of capital investment in that robotics.
Yeah, absolutely. So on Richard's point about globalization, the big economies of the world, China and the US, will have to become more isolationist, more autarkic, because they're going to do less trade with each other. Now, where I disagree with Richard in that I don't think globalization is at an end, because, I mean, we haven't put in tariffs on China. We're still going to be trading with them. We're still a small, open trading nation. Okay, second quiz of the week. So,
just as an aside, it's not that I disagree. It's that I can't really synthesize what's going on and how it's going to pan out, Keith. It's too complicated for me. It feels far too complicated to try and predict what's going to happen.
Well, you've done incredibly well by not predicting what's going to happen, Richard, and just sticking in gold. I wish I'd done the same. So
my prediction there, Keith, was that things were going to get bad, but
yeah, you're right. Now, on second quiz of the week. Now, do you remember back in 2021 when we were doing podcasts and all these Chinese property developers were selling offshore bonds, and we were thinking this was total madness? Why would anyone buy these? Well, they've since defaulted on 150 billions worth of offshore bonds. What has been the recovery rate?
Do I have to have a guess here?
Yeah, go on. Percentage terms.
5%.
5%. 0.6. So, the fundamental problem with investing in China is that, you've got no way of enforcing your claims. That's why I avoid it at all costs.
Yeah.
So clearly the liquidators are favouring domestic creditors over foreign creditors, and foreign bondholders are having immense difficulty enforcing their claims. Yeah. So avoid China. Okay, onto one chart. And this is the effect of tariffs on US inflation. So Goldman Sachs are forecasting that if these tariffs stay in effect, that US inflation is going to rise to 3.5% at its peak this year and stay there for the best part of a year, as opposed to falling to 2.5%. So they're saying core PCE inflation will be 1% higher than it otherwise would have been. And this is the Fed's problem in one chart.
I think, Keith, the Fed has got another problem. Well, I think it's actually got a lot of problems, but the imposition, Liberation Day, one of the consequences of all of this will be that globally governments will be much less inclined to buy US treasuries.
Yes.
So they will have to be funded domestically, which probably means that the Fed will have to buy them, which means more QE ultimately. And I mean, the Fed could buy what it likes, so that then damages the strength of the dollar. It damages the strength of the dollar as the reserve currency. It also, I think, will accelerate the move to diversify reserve currencies, so that
Well,
dollar
I disagree with that, Richard. I don't
dollar
think
isn't the
that's.
only.
Yeah, no, I agree your analysis if that's true, but I think that, you know, actually countries can always fund their deficit if by from domestic purchases, if the domestic investors are willing to buy them. And because, every dollar spent, they're borrowed and is spent in the domestic economy. It's a question whether domestic investors want to use that dollar to then buy US treasuries. And if we go into recession, I suspect they will be. The question is what happens when they come out again?
Hmm. Well, yeah, I mean, you may be right. I mean, certainly they can print the money to fund their deficit,
Yeah.
however they like to do it. But the more long term effect is going to be the diversification away from the dollar hegemony, and
Mm.
I think it'll accelerate that process, and that in turn, I mean, it goes back to the point that Ben Gurion made, that
Yeah.
you're only a superpower as long as you don't use your superpower status,
Yeah.
and
I,
this is part of the loss of the US's control over the world economy.
absolutely. I just think Trump, he thinks he's a great negotiator. I think he's an absolutely appallingly bad one. Now, when you look at what he's done in Ukraine, that hasn't worked, you know, and what he's done here is he's totally overplayed his hand. And I think what will force him to change direction is a sharp slowdown in the US and a collapse in the equity markets.
I think as I told you, Keith, I read the art of the deal, and it was very interesting. But it was written in the late 1970s, I think. So when he was sort of building up his property empire, and I think he was very good at putting property deals together. I think he was exceptionally good at putting property deals together, which is why he was so successful. But in a property deal, everybody's interests are fairly much aligned. I mean, you may say, "Well, if you sell me this, I'll make a great deal more money, and I've got all this leverage over you." But basically, the property goes one way. If you put a
Mm,
deal together, if you sell. The problem with what he's doing now is he's taking that quite simplistic, the view of what is a relatively simplistic transactional process, and applying it to a multi-dimensional,
mm,
where there are multi-dimensional interests, some of which you know, some of which you don't know, some of which you can't predict what the relative importance is, and with all sorts of consequences that you simply can't predict in a complex system. So he's
mm.
taking a simple negotiating process that I believe he is good at, and applying it to a complex situation where it's actually not really applicable.
Yeah, the other thing, I agree with all that, Richard. The other thing I'd say is that he's destroying US soft power.
Yeah, completely.
And, when you look at what US exports, it mainly exports services and brands. And so, when he imposes 49% tariffs on Vietnam, are they going to be more or less inclined to have a Coke, as opposed
Yeah.
to a domestic brand, cola, And, for my own part, I'm less inclined to been thinking about which US brands I consume and if there's a British alternative I can buy, frankly. And
Yeah.
I suspect a lot of people around the world are doing the same. When you hear JD Vance describing Europeans as sponges, etc., etc., it does not make Europeans feel better about the US.
If you take, say, Bangladesh, which has a big trade deficit relative to the size, a big trade deficit with the US.
Mm,
Well, okay, so the US pretty much ceases to import Bangladeshi, but how can Bangladesh rectify that trade deficit?
yes.
What's it going to import from the US?
Yeah, I agree. Yeah.
Supercomputers.
No, I totally agree, Richard. Uh, okay, so on to the UK spring statement, and I have been through the OBR assessment of the spring statement. So the main policy announcements were, so in order to balance the books and meet her own fiscal rules, Reeves cut welfare payments. So that will save 3.4 billion net by 2029, 2030. And that the OBR estimates that will push around 250,000 people, including 50,000 children, into poverty, relative poverty. There were cuts to departmental spending of 3.6 billion by the end of the parliament. Now, reminder that departmental budgets are still much higher than they were pre-COVID, as is the headcount. So it's just getting it back to where it was pre-COVID. Tax compliance measures, really, everyone always says that.
Yes, but it doesn't. They're not going to achieve. I wish them well, but it's just so difficult to achieve that.
Yeah.
And to count it as achieved.
Yeah. They haven't had enough headcount to achieve it, frankly. Now, defense spending is going to increase by 6.4 billion, but part of that's going to be funded by cuts to the overseas aid budget. They've actually increased capital spending, and the OBR has said that boosts to changes the planning system will boost house building to 305,000 houses a year by 2029. Yeah, let's see. But on the economic forecasts, they halved the growth for 2025. Not good. They also raised their inflation forecast for this year. That's going to be subject to a lot of change. But they're saying that inflation will hit 2% by 2027. GDP growth per person of just 0.3% in 2025, after being negative in 2023 and 0.1% in 2024. Tax revenues as a percentage of GDP are going to keep on rising. So, in order to meet her fiscal rules, Rachel Reeves has already baked in tax rises of an enormous 2.4% of GDP over the next couple of years. That's a lot.
That's an interesting summary, Keith. Thank you. What strikes me about all of this is that, the Conservatives grossly mismanaged the economy for their period in office. But the exit route there's this constant, just so Labour MPs, there's this constant cry for, you can't cut welfare, you can't cut this, you can't cut that, we need more tax. And you look where there is effectively they have no baseline other than what it was yesterday. Yeah. And we actually need to go back to what was the baseline, what was the average baseline from 1950 to 2010, something like that. And we should then start to target the size of the state in relation to that, because
the trouble is, Richard, you're absolutely right, but
we have no target.
Well, we've got an aging population who feel very entitled to social care and healthcare, and an aging population is just going to get worse unless you make fundamental reforms, which is your point.
Yeah, and some hard decisions have to be made as to what, how much healthcare can the economy afford, and how is that healthcare to be allocated out to the citizens? And that is, I think that may be something that West Streeting is starting to try to address, but it's something that politicians have hidden from for many, many years, and until it becomes a crisis. But there are some very hard decisions that need to be made over the next few years.
Yes, but we would have to have a mature policy debate in order to make those. And frankly, this country having a mature policy debate, I won't hold my breath. Now, when you look at your point about the irresponsibility of the Tory government, look at this. In 2005, UK debt to GDP below 40, now 100. That is all the Tory government. Just terrible. Throwing money at everything. Just borrowing irresponsibly, and now we need to get that under control. We borrowed far more than the EU equivalent governments.
I have a sort of an existential crisis here, Keith, because I am actually, I am conservative by nature,
Yeah,
and yet the Conservatives did such an abysmal job, and Labour actually is trying to correct it. And
I
you can
agree.
see that they're trying to correct it.
I actually am quite impressed with Labour. And this is investing. So we spent loads of money and didn't invest it. Awful. That's the Tory government. Yeah, so this is the change in debt over the period of the pandemic. Rishi Sunak just turning on the taps.
And being smug about it. That's what
Yeah.
really got me. He didn't say, don't want to do this. It is essential. We will pay for it. He was smug and gloating about it in his statements in Parliament. It's disgraceful.
Well, there were very few people, apart from us, who were pushing back. When you listen to Radio 4, they couldn't spend enough.
It's why aren't you doing more of this, more lockdowns, more disruption of the economy, more borrowing, more loss of freedoms? Yeah.
Yeah. So this is tax revenues by age group. Now, this is quite an interesting chart. You'll see the biggest contributors to tax revenues in the UK are people between the ages of 30 and 60. But actually, people up to 70 are bigger contributors than people in their 20s. That's not something I'd expected.
No. And that presumably includes VAT, doesn't it?
I'm not sure, actually. That's a good question. Not sure. But this is expenditures. And you'll see, so people between the ages of 20 and 70, they contribute much more to the system than they take out. The young, obviously, the state spends money on them and they generate almost no revenue. I'm amazed that people below 10 generate any revenue at all. But then people above 70 are huge negative contributors. And, I'm obviously my father died over Christmas. And, when you look at his, you go into the hospital, it is absolutely full of elderly people in various states of mental incapacity, all of whom are occupying beds for a long period of time. That's only going to get worse because when you look at changes to the population over the next 30 years, you've got falls in young people, big falls in young people, big rises in old people. In order to fix our fiscal problems, we would now have a mature debate about what this country can afford, as opposed to what people feel entitled to.
Precisely. And I think you can't simply burden the young. That's not an appropriate response. You have to.
Yes, I totally agree, Richard. But one of my fears is we are now a gerontocracy. So as the elderly become more of a share of the electorate, they will vote to have more policies that benefit themselves at the expense of the young.
I think Rachel Reeves should have removed the triple lock. I think she should have done that.
Precisely. That is a very good example. Okay, so the economic fiscal outlook from the OBR. So the OBR halved its GDP forecast for 2025, but actually raised it for the rest of the parliament. That's going to change. And after several years of stagnation, it expects UK GDP growth to return to trend later in Parliament. To be fair to the OBR, I can't see any reason why that wouldn't be true. It's been odd, the fall in UK productivity. And the rise in productivity is crucial because when you look at the where they think growth is going to come from, it's a recovery in productivity. The increase in the labour force is still ongoing, actually. That's good. And they're assuming that gilt yields will keep rising. Now, I think that is a conservative approach to budgeting, actually. But if yields come down, that will give Rachel Reeves some a boost, some headroom.
Yeah.
Now, CPI, there's a huge range of outcomes for inflation. And, what's happened since Liberation Day, frankly, I think that will push inflation more to the downside in the UK. You've seen what will take you through the data, but oil prices and gas prices have collapsed. This chart shows the OBR's assessment of the amount of spare capacity in the economy. Now, as of last year, the OBR was forecasting that the UK didn't have any spare capacity. It now thinks we do, and that is good for inflation. It now thinks there's a negative output gap. We have spare capacity. But housing completions have been falling. The OBR expects them to bounce right back to the highest they've been in 40 years. That seems optimistic to me. Fiscal headroom, well, so the measures the Chancellor took amounted to a cumulative 14 billion, so an improvement in the government finances of 14 billion, which is good because since 6 months ago when the OBR last did this exercise, their assessment of the government finances at the end of this parliament had deteriorated by 13.1 billion. So the Chancellor's actions restored headroom. I noticed that tax changes included higher visa and transport fees, passport fees, and council tax. So this is that change in the fiscal headroom. So got higher debt interest because of the rise in gilt yields. So previously, the OBR had thought that the Chancellor would miss her fiscal targets. Now they think the policy changes will restore her fiscal headroom, but only just. And here you have the breakdown of those changes. So the PSBR is now forecast to fall from 4.8% of GDP in 2025, i.e. we're living beyond our means, to 2.1% in 28-29, at which point it will be sustainable. The tax rate will keep on rising. And so most of that change in the fiscal balance is due to higher taxes, not cuts in spending. And the public sector debt should then stabilize around 96% of GDP. But huge amounts of uncertainty won't have improved over the last few weeks. So bottom line is Rachel Reeves has restored her fiscal headroom for now, but if growth comes in below forecast, then she's going to have to raise taxes or change her rules. Watch this space. Now, on that note, let's talk about QE. In fact, QT. So the Bank of England was an enthusiastic user of QE, the most enthusiastic of all the central banks. At one point, it held 37% of all gilts outstanding.
This would be, as a point of information, this was with Mark Carney as the governor of the Bank of England.
Yes. Yeah. Now, unlike other central banks, it is taking a hair shirt of approach to reducing its balance sheet. It is actively selling down its gilt portfolio, in contrast to all the other central banks of the world, which are just letting bonds roll off when they mature. So, unlike other countries, the UK Treasury is paying for the QT losses on the Bank of England's balance sheet with cash transfers from the budget. And so that exacerbates the fiscal deficit. And also, because the Bank of England is not responsible for its losses, it does not appear to be making any attempt to minimize them. So QT is exacerbating the fiscal deficit and the rise in gilt yields. So this is the Bank of England's balance sheet. If it was just letting bonds mature, it would be on this dashed path. As it is, it's actively selling them on this dotted path. And that means it would kind of get back to having a smaller balance sheet by about 2030 and eliminate it by 2032. why this matters is that it's selling best part of 50 billion a year of gilts, and that is costing HM Treasury 23, 24 billion a year in losses. Now, bear in mind that Rachel Reeves' fiscal rule is that she has to have be paying for her day-to-day spending by the end of this parliament, and she has a fiscal headroom of 9.9 billion. Well, 21 billion is being paid out to the Treasury every year. So if the Bank of England were to pause QT or just stop selling down keep its balance sheet the same, it would massively improve government finances. And this is the extent of the profits and losses on QT. Now, we showed you earlier the chart of the UK public debt, and that was actually flattered by the fact that over that period, the Bank of England was sending money to the Treasury to a cumulative total of 122 billion, sorry, 124 billion. Now it's estimated that QE will cost the country net 134 billion. So what that means is over the period of QT, from Q4 2022 to 2032, the Treasury will have to transfer to the Bank of England 258 billion pounds. And that, over that period, that 10-year period, will massively exacerbate the fiscal deficit. So the Tories benefited from QE. Labour is now suffering from QT. And the sales from the Bank of England's asset portfolio are now massively adding to the number of gilts that the market has to absorb. So what you're looking at here is the orange line. During the last 10 years, issuance was larger than the number of gilts that had to be absorbed by the private sector. Now, the opposite is true. So, QT is raising UK yields and exacerbating the fiscal deficit. Now, if the Bank of England wants to help the government and help the country, particularly if the economy now starts to slow, it needs to stop QT. We try to deleverage the public sector, then the private sector needs to re-leverage, and that can only be achieved if interest rates are a lot lower. Watch this space. Any thoughts, Richard?
I don't know. I think the trouble is if they change the method of doing it, won't it be seen as a trick?
Well, I think they can only do it if the UK economy slows substantially, which it could well do.
Yeah. I mean, obviously you know my views on QE. I think they're better off just leaving it as it is and not trying to change it personally. But right. I don't know how quickly the government, how quickly the markets or memory shifts. I suppose there are arguments for doing it either way. What I want to see, I want to see fiscal discipline.
Yes, absolutely.
And the current route is a route of fiscal discipline.
Yeah.
And I think to change it would be a bad thing. I think we actually need to get our house in order, and we need to undo the wrongs of the last 15 years.
Yeah.
To do that, you have to be harsh. And I just think, if we don't do that, this country will simply continue to decline. And so my view is that they were actually, the Labour government had actually dealt a very bad hand by the Conservatives.
Yes, I agree. I completely agree with that.
And they need to fix it. And they need to stick to their guns, and they need to come out and the Conservatives, basically, they need to continue to say the reason that we're having to fix this is because it was totally screwed up by the Conservatives. And I say that as a Conservative because that's the only way to get the Conservatives to change their way of thinking. back to a mature, back to a way of thinking that is they govern for the benefit of the country, not for the benefit of themselves and their mates. Sorry, but I just say we've got, they dug a big hole. The hole, we have to acknowledge that we have to fill that hole in, and we can't. There aren't any shortcuts.
Yeah.
What do you think, Keith?
Well, I think that actually, if the UK economy slows, you need to get interest rates down. Full stop. And so you need to stop QT basically to get control of the long end, because the fundamental problem at the moment is the UK has lost control of the long end of the interest rate curve. And if you want to get investment, then you need interest rates to come down. You need private sectors to start borrowing so that the public sector can deleverage. And so, on your point, yes, we need fiscal deficit discipline because we've got 100% of GDP as total public sector debt, and that needs to come down. We need to deleverage. But if you want to preserve the size of the economy, you need an offsetting increase in private sector borrowing. We're going to skip recession watch and inflation watch and do all those next week. Moving on to other charts, Richard.
Okay, YouTube was the most watched platform on US TVs for only the second time last month. I found it's interesting. So I watch quite a lot of YouTube videos, but I don't like watching them if they're longer than 20 minutes, frankly. And I'm quite careful about the subjects that I'm interested in. And I don't go on the sort of clickbait that you can go on with YouTube. But the problem with YouTube is it's a quick fix.
Yeah.
And a quick fix. And if you watch too many of them, you come away feeling very frustrated.
Well, my point here, Richard, is that when you look at the trend in YouTube, it's up, and traditional broadcasters flat, going nowhere, down. And we used to, when we were growing up, everyone would be watching Blackadder or whatever, where there would be, some sense of society watching the same things and having something, in common. Now, everyone's watching their own thing on YouTube. It's another example of the atomization of society in my book.
Yeah, and I would also say there are some very good YouTube videos, but there's an awful lot of dreadful ones. And I would also say it's another example of the sort of downgrading of educational material.
Yeah.
They're not ours. Obviously, ours is very good.
Not ours.
But there are some really, truly dreadful ones.
Yeah.
They're just drivel, but they have a lot of watches. They have sort of 5 million views or whatever. And you just think, why did anyone view this? Never mind 5 million people. Who are they all? So I completely agree with you. It's part of the atomization of society. Wealth versus happiness. So wealth on the bottom, happiness on the right-hand scale.
Yep.
Where's the UK?
That is a good question, actually.
We're off the scale.
I think we're going to be somewhere here.
Yeah.
But basically, wealth equals happiness. Because I think actually a lot of the prerequisites you need for wealth also equate to happiness. The law and order.
Yeah. Health and well-being.
Yeah. Health and exactly.
Feeling your children are safe. 1889, an artist complains in the New York Sun newspaper that instantaneous photography is a nuisance.
Yeah. Change is inevitable. When we talk about AI, etc., we still have full employment. It's just the mix of jobs changes. So, I wouldn't be too worried about, AI just destroying the employment market.
I think AI is going to be very good for helping balance out the demographics, actually.
Yeah. Okay, and on to good news.
There isn't any.
Yeah. Well, so we need some good news. So this is an ice stupor. So the problem you have in Nepal and Ladakh is that all the glaciers are melting. And so what that means is that when you get snow in the winter, it very quickly runs off. So you get floods in the spring and then no water in the summer. And so what you need to do is find a way of storing water for longer. And if you create artificial glaciers like this, then actually you create longer term storage of water. And so the water then melts more slowly, and you get some runoff in the summer, which allows you to continue irrigating your crops. And so a local man has come up with these ice stupers, and it succeeds in storing water for longer. All you need is a pump and some plastic piping, and the total cost of about $1,500. And they're trying to spread that by holding competitions to see who can build the biggest ones. And that all seems to be working, he says.
Very clever.
Yeah, so some humanity attempting to mitigate the effects of climate change. And on to equities, Richard.
Thanks, Keith. I mean, this is also what I would also comment with all of these is that the equity market's down again this morning. So the FTSE's down about 5%, Germany's down about 6%, US 500 by 4%, US tech by 4%. So take these numbers and add on a chunk, and you get the position today. So clearly, we know what's happened. They've all been hit hard by Liberation Day.
Yeah, I should say all these numbers are as of Sunday, so Monday morning, about 8 a.m. before the European markets opened.
Yeah.
And the Hang Seng, look at that. That's the weekly change, down 17%.
Yeah, exposure to China.
Yeah, shocking numbers.
And the VIX up 96%.
Yeah. Well, finally, the VIX, that is a good high number now.
Yeah.
Previously, VIX was just going nowhere.
But if you look at the price charts, Keith, they're back down to where they were about a year ago. Just not the but the US markets back down to where they were a year ago, and you've got this big spike that has just been sort of chopped off.
Yep.
The FTSE All Share Index, the Euro Stoxx 600, S&P 500.
And your point, just actually still up from its lows last year.
Yeah. Nasdaq Composite, Russell 2000, Hang Seng, Topics, Bitcoin, pound against the dollar, the euro against the dollar. So Trump has succeeded in weakening the dollar a little bit. Dollar index. There's the VIX.
Yeah. Now this feeds through to deleveraging. So, a lot of the equity markets, lots of forced selling as people get margin calls, I'd expect.
Yeah. Retail investors' net purchase of US equities
massively spiked on Thursday. So
they bought the dip. Presumably on Friday they sold the.
You're absolutely right. That's exactly what they did.
Okay, then on Friday they sold. Yeah.
Thank you to Jaw It for sending us those.
I wouldn't go buying this particular dip.
No.
So last time the tariffs were reduced after his initial pronouncements. Will the same thing happen? Well, we don't know, really, do we?
No, we don't. We don't.
I suspect not.
Yeah.
Or at least not in the same way. So this is the Philadelphia Stock Exchange Semiconductor Index, and this is a harbinger of slowing world semiconductor sales. There is quite a decent lagging correlation there.
And this is well before the events of the last week.
Yeah. Net bullish surveyed sentiment. This is presumably, showing investor sentiment has collapsed. So the market's collapsed a bit more than that now. So presumably the whole thing has collapsed a bit further. You can see the US combined PE ratios starting to fall a bit. Still very high though.
Yeah, it's still very high. Valuation is very high.
And valuations are still high in terms of of all sorts of different metrics. So the only one actually, equity risk premium, that's the only one that is fairly valued on this table. Still many that are very expensive. Earnings This is so earnings are likely to fall very sharply. We suspect, particularly for semiconductors, sales are going to drop off. So
Yeah.
there's a lot of room for further falls. The euphoriometer, I suspect that's a bit lower by now as well, but it is.
Yeah. This is actually from this weekend, but you're right. The market's fallen quite a lot further than that.
Yeah, I think some of these. I mean, it's difficult to know where they're going to drop, but you can't see. I can't see the euphoriometer is going to stay there. It has to drop further, doesn't it? US semiconductors market cap weighting, so it's dropped a couple of percent.
Yeah. Still could have a long way to go, if you ask me.
So the Mag 7 had a bad week, but still much higher than the start of 2024. And you can see, I mean, is that a half of a head and shoulders? S&P earnings growth outlook. So analysts reducing their long-term earnings forecasts, though they are still very high.
Yeah, still very high.
Stocks versus bonds, relative valuation.
Still very high. Stocks
Yeah.
are expensive relative to bonds.
Yeah. Margin debt is remaining elevated. I suspect that is falling as we speak, and obviously highly correlated with the level of the stock market. If the US market falls into recession, then the equity market will undoubtedly continue a downward trend. If it doesn't, we have to see. But I think I mean, it's going to such overvalued levels. Trump doesn't care.
Yes.
Presumably the Fed's got a three-line whip, basically not to interfere at the moment. And I think maybe reality is going to start to prevail. And quite a funny little cartoon there. Very clever.
Yeah. Moving on.
Yes.
Moving on to commodities. So it was an absolutely terrible week for commodities. Energy prices collapsed. Industrial metals collapsed except for tin. Precious metals also fell sharply except for gold, which even gold had a bad couple of days, and rhodium, surprisingly. So on energy, well, terrible week. Brent down 10%, WTI down 11%. Reminder, fears about a slowing world economy caused by tariffs are coinciding with OPEC opening the taps. So oil prices, not good. Natural gas futures also collapsing. Fears presumably over economic growth, and that includes US natural gas. So the great news for inflation in the UK is UK and Dutch natural gas futures both down 30% since the start of the year. Great news. Coal continued to fall, uranium actually bucking the trend and up slightly. Still up 10% on the year. So this is Brent just dropped off a cliff. WTI, same. Now, numbers specific to the oil market, well, not reassuring either, because over the last 3 weeks since we last reported, crude inventories in the US actually built by 11 million barrels. US crude production is flat at 13.6 million barrels a day, and the Baker Hughes rig count actually ticked up, which is surprising. Actually, we'll see what it happens in the next few weeks. But the latest survey from the Dallas Fed shows that Permian drillers need $65 a barrel to be profitable. And as of today, WTI is at 60. So, will the market now start to become self-correcting? Will the US drillers, shale drillers, now start to stop drilling, leading to lower supply in the future? This is EU natural gas futures, kaboom. Very different. For last 2 months ago, we worried about rising natural gas prices. Absolutely collapsed. UK the same. That's great news for inflation, by the way. US natural gas futures still high, but off from their peak. Coal collapsing. Uranium seems to have found a bottom. Industrial metals, Richard.
Thank you, Keith. So as Keith mentioned earlier, basically all commodities had a bad week, and you can see there they're all down except tin. And iron ore was only marginally down, as was neodymium, but copper down 10%, aluminium 11%, nickel 12%, zinc 9%. Obviously, all down on the basis of people being worried about there being a slowdown or recession and a big reduction in demand. Personally, I think the world will continue to electrify, so copper demand in the long term will continue to be strong. I don't actually have a view on aluminium and I don't have a view on the others, but I do have that view on copper.
Yeah, I agree with you.
So there we have aluminium.
My God, that's an ugly looking chart.
Isn't it? Cobalt, copper.
On your point, actually, still flat from a year ago.
Yeah. Iron ore, lithium, neodymium, nickel. As Keith has always said, there seems to be lots of nickel in the world. Tin, zinc, precious metals. So actually last week gold was up slightly on the week, although it was down the last couple of days of the week. Silver down nearly 12% on the week, still up year to date 3%. Platinum down 10%, rhodium up nearly 4% and up 20% on the year, and palladium down 8% and unchanged on the year. So a bit of quite a mixed bunch there. There's gold. And gold is rising as a proportion of global reserves, whilst holdings of US treasuries have fallen, part of the loss of the I would say definitely a slow loss of reserve status of the US dollar. I don't think it's going to happen quickly, but there is a gradual trend in that direction.
But he's doing his absolute best to undermine, the US's primacy in the global financial system. Yeah,
he is. So central banks have been net buyers of gold for 15 years. Interesting.
Gordon Brown. Gordon Brown, yes. Yeah.
Don't get me started, Keith. So, but only very recently has retail demand in gold started to pick up. And that actually may have been knocked, the confidence there may have been knocked by the price volatility over the last few days. But I would say that, anyway, and there's silver, which basically just got taken to the woodshed, to coin a phrase.
Yeah.
Platinum, rhodium, palladium.
Yeah. On to rates. So UK yield curve still, not looking very good. The 30-year well above 5%. If we're now facing a slowing economy, the trouble is that the fiscal deficit is poor. But if inflation now comes under control, I really expect the Bank of England is going to need to cut rates hard to support the economy. If the UK goes into recession, then interest rates need to go below R star to stimulate the economy. This is the US the same. The US, unlike the UK, whereas in the UK, we're not imposing tariffs, so we shouldn't see a short-term burst of inflation. In the US, they're stuck. The Fed can't cut rates because inflation is about to rise. But the market still expects disinflation in the coming years, and so that should mean central banks medium term start cutting rates. Trueflation in the US and the UK is coming down. As inflation comes down, so bond yields should come down. Simple as that. But in the US, real yields are not pricing in a recession yet. When a recession arrives, expect bond yields to come right back down. And this is as of last week. Positioning in treasuries was still massively short. there's room for a short, sharp covering rally, which should see a collapse in the 10-year. Okay, so this is the UK 2, it's come down, but still at 3.9%, not pricing in a recession. UK 10, come down. UK 30 years still above 5%. Reminder, I'm hugely long duration. It's been an absolutely disastrous trade. This is helping me, but I'm still massively down on the trade, still not looking clever. This is the US 10. Notice how much further it's come down than the UK 10. UK 10 has only come down a bit. German 10 also coming down. France down. Italian, this is really interesting. As of this morning, and so this is 8 a.m. this morning UK time, the Italian 10-year was up slightly. So is the market worrying about a slowdown in the global economy causing fiscal problems in Italy? We have been forecasting, we've been talking about the Italian fiscal balance for a long time now and how terrible it is and how it's not in control. Could a global recession cause a resurgence of the euro crisis? Greece, the same as Italy. So concluding comments. Well, massive uncertainty. Unless John Trump changes course, we are in for a global economic slowdown. So, Richard, your thoughts?
I think that we don't know where so I think the US stock market is particularly vulnerable to continuing to fall. I think the UK market is less so because it was never overvalued in the first place. I think the European stock market was overvalued, in fact. And if you look at what's happened to the German market over the last few days, it has had that big spike up and it's basically had its spike chopped off. I think you definitely want to be in safe assets. You have to take a view as to what you consider to be safe, and that is not straightforward. I don't think it's too late to move if you wish, if people really want to. I don't think it's too late to move into precious metals. But they can be very volatile, it has to be remembered. And I think we're just in for a prolonged period of uncertainty. I think the sort of frenetic activity that we've got now will settle down at some point, obviously. And it may be that I speak about the UK, it may be that, and I'm hopeful that Starmer is slowly getting a grip on what needs to be done to sort the UK economy out, outside of the influence of the US, which we don't have much control over. But they need to, they've started walking down the right path in my mind, but they haven't got very far down it yet. And we need to make sure they don't get knocked off course. What do you think, Keith?
Okay, so historically, I've made all my money from these situations where there's blood on the streets and you buy when everyone else is panicking.
Yeah.
And for those of you interested, go and have a look at my worst trades. In every single case, I went way too early. Okay, because you psychologically you anchor to the level of the stock market previously. You think, oh, it's down 20%, it's down 30%. I've got to buy. This is great value. The reality is it always goes much worse than you expect. Or historically, that's always been the case. This case, what Donald Trump is doing is changing the world. And, this, unless he changes course, I think stock markets go a lot lower. And so, I would be very wary of buying too soon. But at some stage, there's going to be a historic opportunity to get into these equity markets. I just don't think it's yet.
I think that's right, Keith. I mean, if you look at a chart from NASDAQ now, so in the summer of 2019, it was at 7,800. It is now at 16,700.
Yeah.
So it's more than doubled. And obviously, we've got AI and so forth come through. But fundamentally, is that market worth twice what it was worth in just pre-COVID? And so, in which case it can halve from here.
Yeah, I'd be very wary of taking too much risk in any way, shape, or form of anything. Now, cash is king.
Yeah. And in my mind, gold is cash.
Yes, well, that's true. They're not printing any more of it.
No.
Okay, so that's it for this week. Thank you all very much for sticking with the podcast. And please can you press like and subscribe to the channel. And we will see you next week. Who knows where the world will be next Monday. But in the meantime, it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.